of the Q&A with Cole and Associates. And for people that have been joining right from the beginning of the year, I want to believe that we've been having or getting value for our time, and also learning one or two things along the way also. So I'd like to welcome everybody once again to today's session. And like our custom is, right, during the month we had posted some topics, some discussions, some matters on LinkedIn, on accounting, on tax, on audits, and also on HR related matters, which we believe that many people would have interacted with and also have an idea of what the Q&A would be about today. So basically, I'm just putting it out there for anybody that is just joining us for the first time. The Q&A is just to have like a mini discussion, right, on what we had put out earlier in the month, and also ask some questions that might be on the minds of people, and also give clarity to some things that people might not understand. There will be room for questions if you have questions, and feel free, as much as we would like you to ask questions that relate to what had been posted or put out during the month. No question is bad, like in quotes, is bad. So we welcome all questions also. So for the but rather to start up, right, we would be taking the accounting first. And our guest for today on accounting is Adekemi Bamigboye. Adekemi, are you there? Can you just introduce yourself and just give us a little bit of introduction into the topic?
Good evening, everyone.
Good evening.
My name is Adekemi Bamigboye. I welcome you all to this month's edition of the Q&A section. My name is Bamigboye, as I said. So I'll be talking about the presentation of accounting for withholding tax transaction for financial reporting. So we all know what withholding tax is. So withholding tax is another form of tax. Withholding tax is not another form of tax, but an advance payment of income tax. So on a specific transaction, which is like dividend, we have the royalty, we have the consultancy fee, we have the payment to the contractors, and so on like that. And this withholding is different from the VAT and the payee that we all know. Why? Is because payee is the tax on the employee's income, and the VAT is the transaction that is paid, the tax that is paid by the final consumer of the goods and services. Why this withholding tax is just used to offset or reduce the CIT liability. CIT is company income tax of the company. Is to reduce the company income of the company of a financial year or the reporting year. So the rate at which withholding is deducted is specific depending on the type of the transaction or the party that is involved. So this is just like the withholding tax or the type of transaction that is being involved. We have maybe like for individual or the company. The rate at which it is deducted is different from each other. So after this deduction have been done, so it has been withheld. So it will be remitted to the tax authority, either the state or the Federal Inland Revenue Service, depending on the transaction. Thank you.
All right. Thank you, Kemi, for that short introduction. So just to put more light to what Kemi said as the introduction, withholding tax is not another type of tax, right? Like we would take maybe the VAT, the CIT, and other types of taxes, right? The withholding tax is more like an advanced, or rather an advanced form of payment of tax, especially when it comes to the CIT, right? and both individuals and companies are also liable to that. So, and there are rates which has been given by the tax authority depending on different expenses or transactions as it might be. So, so just give us a bit of introduction into the next one also. I would like to call on our guest for the tax which is Enoch. Enoch, are you on the call? Can you hear me?
Yes, I can hear you.
All right, so can you just give us a little bit of introduction into what your topic would be?
Good evening, everyone.
Good evening.
My name is Olakpade Enoch Temitayo, and this evening we'll be discussing topic which says Nigeria Withholding Tax Reform, the key changes and its application. So, as we all know, that withholding itself is another type of tax, which is used to reduce or used to offset income taxes, as Adekemi have said earlier. And we'll be looking at its application, who and which companies are expected to deduct withholding tax, and what are the rates in which you are supposed to use in applying those transactions, and what are the transactions also that also attract withholding tax. So we need to understand and familiarize ourselves with the rates and its application. And also, we also need to know, okay, what are the documents you need to request from clients or from when dealing with clients, and what are the source documents you need to check for, and what are your necessary as a tax person, what are your necessary area of concern you need to look at that can actually spring forth or make the tax FRS or State Revenue Service for them to be interested in the transactions. So we need to understand what withholding tax itself means, and also need to understand what are the transactions, what are the applications, and what are the penalties for failure in deducting withholding tax. Thank you.
All right, thank you, Enoch, for that short introduction. Like Enoch has mentioned, there are different rates also, which is also what has been said earlier by Adekemi, that the tax authority has given for different transactions, and for the tax, as a tax consultant rather, there are some processes you would have to follow, some things you would have to check, which you would get from your clients when you are to carry out maybe like a tax check on the withholding tax transactions. I know. All right, so for the audit right, we would like to get a bit of introduction also into the auditing process that is being carried out when it comes to auditing withholding tax transactions, and I would be the one giving the short introduction for that. So when it comes to audits and auditing withholding tax transactions, like what Kenny and Enoch had earlier said, it is very important to have an understanding of what the withholding tax is in the first place, right? Because this would help you to know what exactly you have to be on the lookout for and check for when you're looking at the financial statements of your clients. So auditing withholding tax transaction is very important because it also helps to ensure that whoever your client is complying with the tax regulations in the country they are being incorporated in, or in the country they are carrying out their business in. For the audit process, there has to be audit planning, right, which deals with you understanding the applicable laws of the land, and also understanding the period, the financial year period in which such transactions have occurred. Then also the documents you need to check. You have to have an understanding as an auditor of what are actually relevant documents for you to get before you can carry out the audit process on the withholding tax transactions. So this is just a little bit of introduction, just a little bit tidbits from each of us before we now dive deeper into it. So for the last speaker for today, just to give us an introduction also into today's or this month's topic, is Fidelis Dynamic, which is building trust in, if I'm not wrong, in companies' values. Dynamic, please, can you just give us a little bit of introduction into that? Hello, Dynamic, can you hear me? Are you there? Hello, Dynamic, if you are speaking, we can't hear you. All right, while we are waiting for Dynamic to, I'm probably guessing it's network issue, right? So we'll just give a little bit of time. While we are waiting for that, let me come back to Adekemi. Adekemi, are you with us?
Yes, I'm here.
All right. So can you give us more details, right? You've given us an introduction into what withholding tax is. Would like to know, when it comes to accounting, how is the accounting process done for withholding tax transactions?
Okay, thank you, Toluwanimi. Before we go into that, so I'll have to tell us about what the accountants are expected to know or to do when it comes to accounting for withholding tax. So we have the accountant to have so much responsibilities in what they do. So we have the accountant to just the responsibility to just deduct the withholding tax. He or she is just responsible to remit the withholding tax. We have the accountant to just is responsible to issue withholding tax credit notes. Is responsible to just file in the periodic time. He or she is responsible to perform the regular reconciliation, keeping details of documentation, communicate with vendor, then you stay updated to the tax regulations. So I would like to share the some scenarios with us. Can you hear me, please?
Yes, we can hear you. Look at me.
Okay. So there are some scenarios that will occur when it comes to withholding tax. Take for example that I have a company A who enter a contract with company B in purchasing of material worth of 200,000 naira without the VAT and the withholding being deducted. So how do we now account for these journal entries when it comes to accounting? How do you account for it? So let's say WHT and withholding has been exclusive, is being exclusive in this contract. So in that company's A book, how do we account for it? And company B book, how do we account for it? So remember that we have company A and we have company B. Then the contract fee is 200,000 naira. So in accounting, in company A, we record the payable, the withholding payable to be 200,000 naira, 20,000 naira rather. How do we come about the 20,000 naira? We have the withholding deduction, the withholding rate to be 10%. 10% of this contract fee will give us 20,000 naira. We have the payable to be, the trade payable to be 200,000, which is the contract fee itself.
I think I'm sorry to cut you, right? Can you please take the scenario again? Sorry, I lost you for a bit there.
Okay. I said, take for example, we have company A who enter a contract with company B to purchase a material. Okay, someone is ready.
Can see calls and Lepo, can you hear me?
Yeah, I can hear you. Good evening. Good evening, everyone. Please confirm if you can hear me.
Can hear you. Can hear you.
All right. So sorry, everyone. I got carried away with the changes in the time zone. I was looking at my time here. It's showing 5:27, not knowing that it's not the same thing with Nigeria. So I want to give a bit of perspective to what we're discussing so that we don't leave our listener more confused than they came, right? I also want everyone to get this understanding that this platform give an opportunity to both experienced and inexperienced people to showcase their confidence, right, in various things that we are discussing, possibly also build insights on the topic of discussion. So to help Kemi give clarity to what she is trying to say, number one, everyone needs to understand that before withholding tax come to play, there must have been a transaction, right? Whether in terms of rendering of services or in terms of trading of goods, right? There are instances whereby goods or services are exchanged and it is not liable to withholding tax. There are also instances where when this transaction occurs, it is liable to withholding tax, right? It is instructive to note that when transactions are carried out in the ordinary course of business, right, it is not expected to be liable to withholding tax. That is why if you go to a market, a food market or a consumable market, to buying pepper or rice there, you are not expected to, even if you're a company's delegate, you are not expected to deduct the withholding tax from the amount you will be paying to the traders. Reason is that that transaction takes place in the ordinary course of business. Those transactions are not liable to withholding tax. However, if you have a contractor being contracted to supply the same set of food items now, it is expected that that is not in the ordinary course of business. So in that context, being a contract, not you just walking into a public market to say you want to buy XYZ, right? So that in context will be liable to withholding tax, right? So everyone needs to understand. Now, to give guidance to what is liable and what is not liable, right? There are various extracts of the Personal Income Tax Act and the Company Income Tax Act that have big provisions for what should be subject to withholding tax and what should and at what rates, right? We also need to take that into consideration. Now, in the context of accounting for withholding tax transaction, right? Let's give a scenario. I engage the service of an external auditor for a fee of 1 million naira. Now, for everyone who is acting in the capacity of an accountant, need to understand in context what does the contract says. In the first instance, that transaction is liable to withholding tax because it is in a form of a contractual arrangement. Hence, it is liable. So you need to understand, what does the contract says? From experience, we've been able to find out that sometimes that contract or the invoice that may be raised would indicate that the fee is inclusive of withholding tax, or they may be silent, right? In other instances, they may also say that that fee quoted is exclusive of withholding tax. So you must know how to treat inclusive of withholding tax or exclusive of withholding tax. Let me also raise a valid point. In an instance where that invoice also comes with an element of VAT, how then will you treat each and every of these scenarios? So I like to give two different scenarios to portray the two situations. Company A has engaged the service of Adekunle Cole & Co. as their external auditor, and the fee quoted is 1 million naira, which is withholding tax inclusive. In this instance, there is no VAT, right? The amount of the invoice is 1 million naira. The withholding tax rate, let's assume in this instance, is 5%. 5% of 1 million naira will give us 50,000. So how will I post this? Because that is the primary function of the accountant. One, to ensure that the appropriate rate is being deducted and the whole transaction is being posted as appropriate. So total invoice value is 1 million naira. So that will be debited in the audit expense ledger as the expense incurred in respect of the audit, right? The withholding tax element of that transaction is 50,000 naira. That will be credited in a ledger called withholding tax payable, right? Now, if you deduct 50,000 from the 1 million naira, you are left with 950,000. That 950,000 will then be credited in the payable ledger of the auditor. That is the amount in net that you will have to pay to the auditor upon the completion of the contract. Now, this scenario is different where there is an element of VAT on that invoice. Let's take this instance that the value raised is 1,075,000 naira, right? 75,000 naira there representing the VAT element. So the question will be, what is the total expense incurred? It is 1,075,000. So 1,075,000 will be debited in the expense ledger as audit expense, right? Then don't forget, it is only the value net of VAT that will be liable to withholding tax. So withholding tax in this transaction will still remain 50,000, right? So that 50,000 will be credited in withholding tax payable, right? While the balance, deducting 50,000 from the 1,075,000, which will give you 1,025,000, will then be debited in the payable ledger for the auditor. Take into consideration of all of these scenario, how it is being addressed. So the next question I would like to push, technically I've taken charge from you. The next question I would then to push is that, to Enoch, the accountant has booked this amount. What would you do in your regular spot check of the client's record, right, on how to verify that that amount book has been appropriate, and what would you consider in determining the appropriate place to remit the sum? Is Enoch there? Enoch, can you hear me?
Yes, I can hear you, sir.
Yeah. Do you understand my question?
We'll come again, sir. I think the network was bad then.
Very often, clients will call you as a tax consultant to saying, we have withholding tax that we have deducted. We want to remit, but we don't know where to remit to. So let our listeners know, what procedure would you follow in determining the appropriateness of what has been deducted, first of all, and where to make the remittance to, including the timeline for the remittance.
All right, thank you so much. But so, as regard that, if a company has contacted you and they have carried out a transaction and they have informed you that they want to they have carried the transaction, you need to first understand who are the party involved, which party is involved. Is it a limited liability company or an enterprise, which is also an individual? You need to understand that. That should be the number one thing you need to get. And you also need to confirm the rates which they have used. Is it the applicable rate? So after you have tested the rate for the rate, so let me put an example now. For a service which carry a rate of 5%, so for a transaction of 10 million naira and a rate of 5%, which is 50,000 naira, and if the transaction is being done by, let's say, Atipejo Enterprises, so for that particular transaction, that's actually signifying that the company actually transacts with an enterprise or an individual. So that kind of transaction is going to be remitted to the state internal revenue service. And if in another scenario, if the transaction will actually be carried out with a limited company, that means that kind of transaction will be remitted to the federal internal revenue service. So we need to be able to differentiate which party is involved in the transaction. Where is the remittance going to? So you need to go and pay what belongs to FRS to State Internal Revenue Service, and what belongs to State Internal Revenue Service to go and pay to FRS. So you need to first of all identify the applicable rates if the company actually deducts the right withholding, and which party is involved. Thank you, sir.
All right, thank you very much. I believe our listeners are listening to this. Please, if you are not speaking to your mic. So as an accountant, you have made your estimate and you have posted the amount based on your own understanding. But the tax consultant in you or whoever acting in that capacity will still need to do a reperformance test on it, confirming whether you have used the right rates. If the right rates have not been used, query will be raised to ensure that you use the right rate. The tax consultant in you may not tell the accountant how to post the transaction. You don't have a business with that. But you will have picked the engagement letter where applicable, or the invoice where applicable, confirm the substance of the transaction, and check whether the appropriate rate has been used. And like you rightly said, you could have had such transaction with just an individual or registered person. Where that is the case, remittance is to be made to the State Internal Revenue Service of the state where that person is resident. So if you have James Olaopa, who has come to Lagos but ordinarily resident in Ogun State, to do or complete a contract in his capacity as James Olaopa, When the company wants to remit its withholding tax, it must be remitted to the Ogun State Internal Revenue Service, even though that transaction took place in Lagos. Later on, I will let you know why that is so. But if that transaction took place with a registered business name or a partnership business name, right? That will also be remitted in the state where that partnership is located. So if the partnership business or the sole proprietorship business is located in Rivers State, for example, remittances will be made to the Rivers State Internal Revenue Service. But if the transaction took place with an incorporated entity, right, then in that instance, remittance will be made to the FIRS. Please, I urge you to pay due attention to this, because we have found out that many a time people make mistake of remitting to the wrong places, right? So let me come on the auditor. I'd like you to enlighten our audience on what is expected of you as the external auditor who is in charge of the audit process relating to withholding tax and related transactions.
All right. Thank you for that, Cole. So as an auditor, like Cole has mentioned, you need to have an understanding of what the withholding tax is in the first place, right? And the auditor is coming in not to do the books, right? More like to check, a compliance check, sort of, that what should be done has actually been done in line with the regulations that has been given by the tax authority. So when the auditor is coming up to audit withholding tax transactions, the auditor has to plan. There's a plan that goes into it. You don't just go to the client and just say, okay, what were the transactions you carried out during the year? Which one is liable to withholding tax? And just take it like that. As an auditor, you have to know what applicable rates there are to the different transactions that might occur in a particular company, or whatever expenses that might have gone on, to be sure that the applicable rates have been applied to those transactions. Also, as an auditor, you have to be sure of what documentations you're asking for from the client. You know, we've seen there are cases whereby some clients do not have the full documentation that are necessary. There are some that have everything right in their books and also documented, saved. So you have to know what you're asking for. So there are cases where you might have to get the ledgers for each of those transactions as might be liable to withholding tax. You would have to ask for SLAs that the clients might have with their own customers, with their vendors. You might have to get their invoices. Worst case scenario, you might get the bank statement that shows the payments that was made out to such vendors, just to confirm that what should have been done has been done by the client. And you might also need to get evidences of remittances. If your client is withholding such amount, you would have to also get evidences to show that truly they've remitted also to the tax authority. Because as an auditor, you are responsible for ensuring that your client is complying with the statutory bodies that they are under or they are obligated to remit to. And as an auditor, you also have to ensure that the withholding taxes are remitted within the time frame that has been given by the tax authority, which for FRS is 21 days after the month, right? So you have to make sure that those things, any stipulated laws are followed, strictly adhered to, because this will also help you to advise your clients properly, where they can avoid fines, avoid penalties might come up if they are not strictly following it. I don't know, Paul, if you would want me to go deeper into it.
Yeah, not yet. We will. It's becoming very interesting. We will dive into it gradually. Let me take you a little step further, because our audience will also like to know, other than checking the compliance, a number of times you notice some irregularity, either due to your own investigative process, or you see the report that the tax consultant has given. So let's look at this instance that you are in the course of auditing that section of the account, and you saw that on a transaction, I believe you can hear me.
Yes, I can.
On a transaction that ordinarily should should be liable to withholding tax at 10% rates, right? Your client has actually booked that expense and charged withholding tax at 5%, right? You saw the report, your performance test actually revealed that, and also corroborated with the recommendation of the tax consultant, right? In correcting this before the account is finalized, what would you do? What journals will be raised, and how will that be? Let me not put hands into your mouth. Just say it.
All right. Okay, that's fine. So if we are performing like a performance test and we find out that a transaction that should have ordinarily been liable to 10% has been liable to 5% instead, that is a shortfall in the compliance, right? So for us as auditors, in the course of our work, we usually raise audit journals if there are cases that require it to correct whatever errors or misstatement has been done. So in this case, usually when a transaction has occurred that is liable to withholding tax, most of the time it's usually an expense, which would mean that the expense has been understated in such a case. And also the withholding tax payable that should be payable or that should be remitted to the tax authority is also understated. So first, we would have to understand what the transaction is, then also get the, if it's something that the client got an invoice for, get the invoiced amount, get the invoiced amount for that. Then, because the client has initially recognized just or applied the rate of 5%, that's a short of another 5%. So for that, we would now pick the original amount. So it can be two things, right? If you want to go mathematically, you can pick the original amount, then apply the full 10% on it, right? So that you get what the withholding tax should have been. Let's assume that the client did not even apply that 5% at all. So once you're able to get that full 10%, then you can now check it against the 5% that has been initially recognized, then get the difference. Because if you are doing a full 10% and your client has recognized 5%, once you deduct that, you would get the outstanding 5% from that. So that's one way you can go about it. So the journal you'll be raising in that case is that you'll be debiting your expense with the outstanding 5% amount that you've now gotten with. You debit your expense while you credit your withholding tax payable to balance up or to actually present accurately the figure that should have been there.
Okay, thank you very much. But still with you, many a time we see instances where there are some ledgers we call withholding tax payable. There are some we also call withholding tax receivable. From your audit experience, how can you differentiate the two for the benefit of our listeners?
All right. So differentiating withholding tax payable and receivable. So most times, from what I have seen, withholding tax payable most of the time is when the client is the one doing the withholding. So let's say the client has a vendor or a customer that they are supposed to pay a particular amount. They would have applied the applicable rate on such person's invoiced amount before they pay the person. So the amount they have withheld would be what they would have recorded in their withholding tax payable that they're supposed to remit to the tax authority. Most of the time, that's what is there. And in the case of withholding tax receivable, this is the reverse now. So most of the time, what you will find in withholding tax receivable is a case whereby someone, or how do I put it, the client now has rendered a service to someone else, and the person has withheld from what the client should have gotten. So ordinarily, the client would know that, okay, this person has withheld 5%, 10% from my fee. So I'm expecting that this person will remit this particular amount on my behalf to the tax authority. So while withholding tax payable is what the client themselves have withheld from their own customers, the receivable is the reverse, which is what their own customer has withheld from their own fee.
Awesome. Thank you very much. I believe our listeners heard that correctly. Withholding tax may be withholding tax payable, and sometimes it may be withholding tax receivable. So if I am a firm of chartered accountants and I have rendered services to a number of clients, upon receipt of my professional fee, it is only expected that the client, under the given regulation, should deduct, where applicable, withholding tax due on my fee. So to me, who is the firm that has earned the income, that withholding tax deducted, it's called withholding tax receivable. But on the other way around, still using my instance as a firm of chartered accountants, I may have a number of people, vendors that render services to me, right? In that instance, the fee that they are due to earn, right, before I pay them their fee, I would have to deduct withholding tax. That withholding tax is called withholding tax payable. So there are two different withholding tax, and the accountant in us give us a set of guidance that these two ledgers must not be merged together, must be maintained separately. I'd like to quickly pick on Enoch. Sometimes we see instances whereby you have done CIT computation for a client, right? And the CIT payable for the period has been ascertained, right? And the client raised query that, oh, if my CIT payable is say 100 million, and they have withholding tax that has been deducted from them, what is the relevance of that? How would you apply that in the course of filing returns for your client, or where that occurs in an audit?
All right, sir. Thank you, sir. So in the aspect of computing for company income tax CIT, and if you have actually raised or gotten a liability of, let's say, 10 million naira, and the client is saying, oh, this is the liability, but the company have also been deducting, or vendors have also been deducting withholding. So first of all, I need to make the client to understand that withholding itself is not really a tax. It's just another type of tax, and it's actually used to offset income tax. So at the point of filing for my CIT, imputing the information as regards the financial statement and uploading the other financial statements. At the point of when I get the form, there's a part where we say, do you want to offset with your withholding credit? So at that aspect, I need to click that, so the client will be able to benefit from the withholding credit he or she has. And also, it depends. Sometimes you might have a withholding credit that is even more than what you want to pay. So in that scenario, it is possible for a client not to even pay any cash in form of CIT if the withholding credit is enough to cover the CIT liability. And situation whereby the withholding tax is not enough, that means it will be after using the withholding tax credits, then the client will need to pay the remaining CIT in form of cash. So that is just the application in that scenario. If you want to file compute after application. All right, thank you, sir.
All right, thank you very much. I believe all our listeners get that very clear. So it is possible that your client had suffered withholding tax based on the transaction they have done before now, right? Upon whether it is an individual or an incorporated entity, that withholding tax that has been deducted, which to them is a withholding tax receivable, may be used to offset their personal income tax liability or company income tax liability. Please note, withholding tax will not be used in offsetting other form of taxes other than PIT and CIT. If it is in a case with a petroleum company, of course, that will be applicable. It's still a sort of company income tax, but peculiar to those operating in that sector, right? So my point is, you won't have a capital gains tax due to be paid, and you want to claim that you can use your withholding tax receivable to offset it. It's not possible, right? And you can also not use that to offset your education tax, police trust fund, NSSTF, and the likes. It is not applicable. You can only use it to offset company-related taxes. Are you set to go? You're set to go, right? Are you ready to go in?
Yeah, mate.
Yeah, good. That's fine.
All right.
Yeah, see you later. Yeah. Sorry. So like I was saying, you need to have that clearly stated. But I have a point again I want to clear. You made mention of credit notes, withholding tax credit. Are you saying that it could be different from withholding tax receivable on its own? Can you differentiate them? Withholding tax receivable and withholding tax credit notes. Olopade, to you now. Can you tell our audience the difference between the two?
All right, sir. Thank you, sir. So what we mean by withholding tax receivable is when your vendors have actually deduct withholding tax from their own end when you transact with the vendor, and they have actually deducted withholding tax from their own end. That's what by withholding tax receivable, because you are expecting they will be one to remit on your behalf. By withholding tax receivable. While withholding tax credit note is when you have excess after the remission. This is when you have excess of withholding credits or withholding tax.
No, you don't get what I'm saying.
I think this is done by.
Olopade gets me. What I'm saying is that, could you differentiate what happens when that withholding tax is deducted before when whoever that have deducted it remit it? Because I believe there are instances where a client or a taxpayer could have suffered withholding tax deducted on its fee, right? But whoever that withheld that sum has not remitted it. So when the withholding tax deducted, which is the withholding tax receivable, before it is being remitted to the appropriate tax authority, it is said to be withholding tax receivable, right? But when it is then remitted, it is said to be withholding tax credit note. That is when it can then be utilized as a credit. Please, I'd like everyone to take that into consideration. The fact that you have withholding tax receivable does not automatically translate to the fact that you can use it to offset your income tax. You need to validate that withholding tax that has been so deducted has been remitted, right? When it is so deducted and subsequently remitted, you call it withholding tax credit note. So that tells you also that your withholding tax on the side of receivable can still remain withholding tax receivable, meaning it might not have been remitted. But the moment remittance has been confirmed, in the case with FIRS, you will be able to verify it on their portal, right? But in the case with the State Internal Revenue Service, you should be able to obtain evidence of the remittance, one, or some other internet services like LIRS. You have the opportunity to verify it on your portal. Please take that into consideration. Let me quickly come to you. You have audited, or you are auditing a client, right? Is Nemi there?
Yes, I'm with you, sir.
You are auditing a client and you verify that in a particular year, the prior year before the year you are auditing, there was CIT payable of, say, 150 million, right? You could not verify any way, means through which that liability has been paid, right? But on further inquiry, the client confirmed to you that they had used the credit note to offset the liability. What sort of journal entry will you recommend that the client pass to effecting that? Please confirm whether you understand my question.
Yes, I understand your question, sir.
Okay.
All right. So in a case where the client had 150 million as their, just to be clear, the 150 million is purely their CIT.
Purely their CIT.
Okay.
Right. And they confirmed that CIT, you were looking for evidence that whether it has been settled. You check your bank transaction, you didn't see anything, right? Mm-hmm. Of course, that sort of transaction could not have been paid in cash. Mm-hmm. So the inquisitiveness in you makes you to further ask, can you give me evidence that it has been done? They provided the evidence and you saw that they had used a credit note to offset that particular liability. But their balance sheet is still showing 150 million CIT payable, okay, right? What would you recommend to be done to make it reflective of the substance?
Okay, so before I give the journal, right, I would like to state that even if the client had told me that they used their credit note to offset it, I would also make sure that the credit note, I can also see that from that end before I go ahead with adjusting the figures. So the journal would ordinarily be that I would have to debit their CIT payable and credit the withholding tax credit note, which is why I said that I would have to first confirm that they actually had such credit notes in place to actually offset it. Because there are cases whereby, like you earlier explained, some clients would say that because they have withholding tax receivables, they would want to use that. I'm talking about the journal now, to take it against the payable, which should not be the case. So most times for clients that usually have a lot of withholding tax receivables and credit notes, both are always separated to show that receivable is receivable. You've not yet gotten evidences that they were remitted on your behalf, while your withholding tax credit notes are what you can actually utilize to offset your withholding tax, or your CIT liabilities. So it has to be the withholding tax credit notes ledger against the CIT payable.
Absolutely well noted. Thank you very much, Nimi. And I believe everyone could get that. If there is any who has been struggling with that before now, please take notes. You need to validate the fact that the client confirmed to you that we use credit note is not enough. You need to verify where is the confirmation of that returns filed that actually acknowledges that, and upon that verification, right, you can then recommend that the appropriate entries, which is reducing the credit note that they have by crediting the withholding tax credit note and debiting the CIT payable. Thank you very much. I'd like to go back to everybody now. I believe you've been listening to us. This very session is anchored by KCP, a firm of chartered accountants. We are doing this because, as much as possible, we are keen at improving the standard of professional practice and enhancing the skills of our core professionals. I don't know whether anybody has any question based on what has been discussed thus far. I don't know whether you have a peculiar case you have encountered in the course of your work, or the ones you stumble on some sort and you want a second opinion on. The window is open now for you to ask in question before we go ahead. Any question from anybody? Okay, I think Ezekiel wants to ask a question. I see your hand indicated. Unmute and ask a question, please.
Okay, good evening, ma'am.
Good evening,
Hello,
sir.
good evening, all. Yeah. Yes, I quickly want to note as regard the withholding tax receivable and the withholding tax receipt accounts. Just like you said, ma'am, I think I have a challenge at the time where the withholding tax receivable accounts and the withholding tax credit accounts are used interchangeably. So I eventually, in solving my problem, I go to the tax promas. Those remittances that I see that have been remitted by the customer that we are deducted from us, additional adjustments we have passed to separate those ones that we have seen on the withholding tax on the tax promas portal by debiting withholding tax credits and crediting receivables, because from the receivable is the global of what have been deducted from us, which we are expecting that it will be turned over to the Federal Land Revenue. So what I think we can do, additional journal that we can raise so that we will not be able to miss both the receivable and the withholding tax credit, is to move from the withholding tax receivable account to withholding tax credit account, so that just like you said, for that outstanding liability, we can now debit the tax liability and credit withholding tax receipt, not withholding tax receivable, because those ones are not being remitted and they are not seen on the tax promas. I just feel that I can share that so that you'll be able to separate properly, between withholding tax receivable and withholding tax credit. Thank you.
Yeah, very valid points you have raised, and I believe everyone has also drawn insights from that, right? Whether as accountants, you need to regularly confirm what portion of the withholding tax receivable has been remitted by your client or your customer who made the earlier deduction. And to the extent that you could validate, you need to reclassify the portion or all of the withholding tax receivable that has been confirmed to have been remitted into the withholding tax credit note account. And like Israel emphasized, in doing that, you will have to debit withholding tax credit notes, right? And credit withholding tax receivable. I'd like to take that again. If you have confirmed, let's assume you have in your withholding tax receivable ledger 250 million. And upon your inquiry, you confirm that 200 million of this sum has already been validated on FIRS portal. So what you then need to do is to debit your withholding tax receivable with 200 million that have been verified, and credit your withholding tax receivable with 200 million. The first one is the credit note, right, that you are debiting with 200 million. The other one is just the receivable account, that is withholding tax receivable, that you are crediting with 200 million. At the end of the day, your balances will then be withholding tax credit note will show a ledger debit balance of 200 million, right? While your withholding tax receivable will show a debit balance of 50 million. You still have the 250, but this time it has been categorized. So in the event that you want to use it to offset the CIT, as the case may be, you are making the movement from the credit note account to the CIT payable account. Thank you very much, Mr. Ezekiel. I think somebody else also have something to say. Jamil, you have the floor, please.
Hello, good evening.
Good evening, sir. You have the floor, sir.
Hello.
Go ahead, please. The floor. We can hear you.
Okay. Yeah, my own question is that are you saying that we cannot go the way you said initially, like you have withholding tax receivable, and when you now confirm, you validate the one that the customers have already remitted, you now use that one to eat when you okay fine. Let's say you when you validate it, you assume okay fine, the customer has, maybe you have withholding tax receivable of 10 million naira or 500,000 naira, and you validate like 500,000 out of 10 million naira. So when we now want to do the offsetting, can't we eat the receivable? So for far away, we're still going to have a balance that's showing there, and then we now eat the CIT. Like for example, now you credit receivable and debit the CIT. I don't know, can't it go like that, or the way the Mr. Ezekiel said now? Because the other one you said, I'm just thinking of, can we do it the other way, instead of having credit account, also having a receivable account?
Okay, thank you very much. And in responding to that, remember, in our earlier discussion, we had stressed the difference between withholding tax credit note and withholding tax receivable, right? These two ledgers are distinct ledgers and they implies different things. Everything you have in your receivable is connoting what has been deducted but you've not validated the remittance. So, and you will also bear us witness that when I put the auditor on the spot, she did not make reference to the receivable. She did emphasize the credit note. So from time to time, that adjustment should be made from the receivable, the withholding tax credit note ledger, not your withholding tax receivable. Withholding tax receivable implies what has been deducted but has not been remitted. But I understand the fact that sometimes many accountants forget to make that separation, right? And that is why when auditors come on the spot, they are also expected to validate what portion of the receivable has been remitted, such that recommendation for that separation has to be made. I hope that is clear, Mr. Jamil.
Yeah, thank you, sir. Yeah.
Thank you very much. Any other question from anyone before we take the conversation further? Please don't feel shy. Feel free to let us know whether you want to make additional contribution like Ezekiel stressed, or you have certain concern relating to this or any other area that may be of concern. Feel free to hear your views. Right, so while we are still waiting for that, I don't know whether Dynamic is ready now. Dynamic, are you ready?
Good evening, sir. Can you hear me?
Yeah, we can hear you. We tried reaching you before, but your network was not too stable then.
I'm so sorry about that, sir.
That's okay. Can you let our audience know what you have for us?
Oh, today I'll be speaking on building trust in company culture. Right. As we know that trust is important in building company culture. It's one of the main pillars of an organization, and so it is very important. It's one of the top tier things that we need to focus on. So I'm grateful for this topic, and I'll just quickly delve into what I have for us today. Right. I was speaking on why trust matters and the benefits of trust, the core elements of a trustworthy culture. Right. But before then, I would just like to quickly explain what company culture means. And I have here that company culture are the shared values and norms of an organization or organization members, right? The values are what is considered important, and the norms define appropriate employee attitudes and behaviors, right? So these are mannerisms, your way to work, how you deliver your work on time. These are cultures. Some companies don't have any patience for when you say, oh, you're supposed to deliver this in 24 hours and you have not delivered it in 36 hours. You might be sent a query. This is part of the company culture, right? At KCP, we have core values that we call presets. We have prudency, we have respect, we have integrity, we have client-centric, we have empathy, we have teamwork and timeliness. These are things that we strive to live by day to day in our work-life experience and matters. We strive every day to look at this. And so there and then I'll quickly rush into core elements of a trustworthy culture. And for trust to be effective in an organization, there has to be transparency, there has to be consistency and fairness, there has to be psychological safety. Why is this important? When, let's say, the management of an organization is not being transparent with whatever it is that's going on in an organization, the employees in turn feel not safe. They feel like maybe there are some things that are going on that they are not privy to, and so maybe there's no fairness, and okay, maybe if I report this employee, maybe my employer has a favorite, and so if I report this employee for doing this to me, they might not take my side or something like that. And so this can, break trust in some kind of way if the management of a company is not trustworthy, right? Consistency and fairness. If you are not consistent as an organization, we see that it trickles down to the employees as a whole. And so these people are not able to, we as employees, we are not able to follow the precepts, we are not able to follow the landmark that has been built for us, because oh, that's how they do, let me just continue doing how they do. But where we see that consistency and fairness are coming into play, and we see that that's what we met there, it's going to be very important. In 1966, the University of Wisconsin-Madison, they carried out this monkey experiment that I would like to just quickly speak about. So they brought in 6 monkeys, and they put banana at the top of the ladder. That any monkey that tries to take the banana, they are going to spray them with very cold water. And so one monkey tried it. They sprayed not only the monkey that tried, but also the remaining 5 monkeys that were not even trying to get the banana. And so this continued. They removed one monkey, they returned the another monkey, and until the first 6 monkeys have been changed. And they noticed in the experiment that even the new monkeys that they were bringing in, just because of these other monkeys that were there were beating them from taking the banana, they were able to, even though they did not notice, they did not experience being sprayed cold water from the sprayers that were there, the sprinklers that were there rather, they did not go up to take the banana because of the fear of their peers beating them from taking the banana. So I'm not saying we are monkeys, but this was an experiment, right? And you can see here that this culture of the new monkeys came into a culture whereby nobody had to go up the ladder to take the banana, and so they were able to inculcate that even without experiencing what might have caused them to be beating each other to take the banana. So I would like to just use that same example to buttress my point on consistency and fairness. And then psychological safety. That would be my last point for core elements of trust of a trustworthy culture. Psychological safety is so important. I have a quote here that I just love so much. It said, "A salary increase makes you happy once a year. A healthy culture keeps you healthy every day." Right? If you come into an organization and you don't feel safe, if you come into an organization, no matter the pay and whatever it is that you earn, you will not be able to try, you will not be able to do your best, carry out your best, because the culture there is very toxic, and psychologically you are not safe, right? So it's very important that mentally, physically, psychologically, employers focus on employees' psychological safety, so that they feel at ease and able to trust the organization that come what may, I am able to carry out the best that I can, and do my best for the company without feeling that someone is going to talk me down, or someone is going to be bossy around me, or someone is going to just do something that I am not even at fault and just talk down on me. So psychological safety is very important, if not the most important point on this session. And finally, I'll be speaking on the roles of leadership in building trust.
Sorry to cut you. I would like to ask a question, right? Just for us to better understand it. So I want to pick consistency, right?
All right.
Using the experiments that you mentioned, whereby over time, after they had been treated to the cold water treatment and new monkeys came in, and because of what the older ones had experienced, right, those ones just followed suit. In a case whereby we are in an organization, right, and let's say there has been now I'm putting this in quote, an ongoing culture that is not actually part of the values and system that the company actually wants to be in place. And we're having new people that are coming in. How do we reorientate the new ones and even the old ones, right, to make sure that what the company actually stands for is being enforced in such an organization?
All right. Thank you very much for the question.
I think Vanessa's hand is up. Yeah.
All right. I'll quickly answer that and we'll get straight to Vanessa. Is that okay?
Yes, that's fine. You can go ahead.
So I was going to that place. I was trying to talk on leadership, right? My answer to that would be leadership. Because, we run an organization, for example, what the employees see the leadership of a company do is it's going to take some time, but it's what they would like to inculcate. Because imagine your employer says, you know what, do this for the client and submit in the next 18 hours, and you are not able to submit to that regard, and your employer is supposed to do something, and the employer does it at the set time that you did it. You as an employee are forced, right, to take up this, let's call it work. That's not what I want to do, but you are forced to take up this responsibility to do your work at the set time. And where structures are in place whereby you are being queried, you as an employee will not like to be queried for not doing your work at the set time. So in an organization whereby consistency is not part of their core values, and maybe they employ a new manager that is saying that that's a character flaw and wants to put this in place, after having like few seminars talking about this, maybe a meeting or like this kind of training talking about this, and the employees see that these are things that are trying to implement, I think with time, giving the employees grace to be able to get themselves familiar with the system, they will be able to lead through the leaders that are leading by example. They will be able to inculcate this into their own personal work and their personal work. Yeah.
Thank you very much for that. So a lot rests on leadership, basically. Vanessa, please, can you go ahead if you have a question or a contribution or something?
Can you hear me? Sorry, I was talking. I didn't know I was on mute. Can you hear me? Good evening, Dynamic. Good evening, Tolu and Imi. Okay, so I just have just one question to Dynamic. How certain are you that organizational decisions are fair and unbiased to its employees? Yeah, thank you.
So how certain am I that employers' decisions are fair to employees, right?
Exactly.
Right. So I was speaking on structure earlier, right? For organizations that have handbooks, I think most decisions should be unbiased because you are going according to the handbook of the organization. And right, I was speaking on fairness also. Employers should be able to sit back and see if one party is not benefiting more than the other, right? And also, it is very important that we take into cognizance that sometimes, because of maybe lack of self-reflection, some employees might not put things into perspective or put themselves into the shoes of probably the people making the decision, and maybe just problems and things that the decisions that the management maybe came to into conclusion with it's being unfair. And so we should also put that into perspective too. But from my end, I would just say that just to be unbiased. I don't think it's very rare for the decisions made by the organizations for organizations to be always unbiased. But as much as possible, we make sure that whatever it is that we are doing, we seek third parties and we make sure that it is unbiased and it is fair. So I don't know if I've answered your question because that's a very deep question, but I think I have scratched the surface if I want to say that.
Yeah, thank you, Dynamic. I guess Grace is raising up her hands.
All right,
Okay.
Grace, you can go ahead, please.
Hi, good evening, everyone. Yeah, I just want to add to give my own opinion on Vanessa's question. So I think that there are standards to the pros and cons, and the way things are done in organizations. So I'm sure we have benchmarks by industries. So I think the first thing the employee is supposed to do, or the employer, is to, based on this decision or the decision they want to make, they should benchmark what is achievable in other organizations in the same industry as they are. So that should also help guide them. And to me, I think fair is subjective, because what is fair to me as an employee might not be fair to my employer. Do you understand? So I think they should always try to look out for industry benchmark. For instance, now, okay, you have a particular role. What's the salary attainable for this particular level in other industries? Okay, how many years have you been? Okay, what is due to you as an employee, or what are you supposed to do in this position? Maybe you're in management level, there are certain responsibilities you're supposed to deliver at that level. When you benchmark it with organizers, and again, so that we don't start, benchmarking small company with large company. So that would be like companies within the same growth level. Like this company has been 5 years, this company has, okay, what is practicable, or what do they do in their firm, and what is acceptable? So we should also try to also draw from the value system of the organization. So if the value system is empathy, contribution, or whatever you have, maybe honesty or something. So whatever the organization is dishing out, or whatever rules and regulation, must also be in line with their values. And there's no company that is going to give bad values. So values are what they are, and they also must be regulated. So yeah, that's my contribution. Thank you.
All right, thank you very much for that. Thank you. Jamil, I can see your hand up also. You have a question?
Yeah, I just want to I didn't know. I know the topic is on public culture, but I don't see whereby the speaker talked about respect. Because this is a key thing that has to do with public culture.
I can't hear you. I can't hear you, Janet.
What's it?
So the line is
I can't hear you.
What's it?
Your line is sort of breaking. The network is, I think, is breaking.
Okay.
Your WhatsApp.
What about now?
It's much better.
So I'm talking about respect in the part of public culture, because I did not mention that, and it's part of what I said that it's a key thing. Or really, someone like me, my common thing, whereby you by an employee, I did a good job, the employer will not call you for attention and say, very good job, I love what you have done. It's a very long way, and a kind of a sense of responsibility, and also giving that kind of employee a way of increasing in terms of work done. And then, how do I put it? So what I'm trying to say is that it gives that kind of what's called satisfaction, and then react to that job. So I don't know if the speaker will speak more on that, so that we can, or someone like me, if an employer told me that you have done well, in respect of the kind of money I'm earning, I always put my effort in kind of a thing. So if you are looking at the employee aspect, you also look at the employer aspect. If the employer is doing the work right, not everything that has to do with advantage of the employee we are going to be looking at when it comes to public sector. That's all.
Oh, all right. I think I get your question. I think I get your question. So I will say the question back so you like confirm if that's what I said. You are saying that I should not only focus on the employer but also on the employee. That if the employer tells the employee that he or she did a good job, that will make the employee want to do more in subsequent endeavors given, right?
Yes.
All right. So actually, I'm not done with my presentation. I would have touched on that. Thank you for raising that question. That's a very important question. So, Gravity Payments Incorporation, its CEO, Dan Price, right, in 2015, it announced that it will be the benchmark of their salary will be $70,000, right, which is very rare in a capitalist country in the US, right? And just follow my story so you understand what I'm trying to say at the end of this. Can you hear me?
Yes, I can.
All right.
Yeah,
So I'll
continue.
keep with this. And so people were fighting it. And at the end of the day, he increased the salary. That was the benchmark for everybody. So I'll just give you the name so you can go and read on it and do your own personal research. But at the end of the day, because he was able to sacrifice and all of that, the employees, due to accountability and continuous communication, they were able to also sacrifice for the company during the COVID-19 period. So yes, your question is very, very valid in the sense that when continuous affirmations are given to these employees and not just talked down on, and they're not just talked down on, this will make the employees to want to do better for the organization and also strive to be better themselves. When an organization whereby your inputs is not even recognized, so they even ask, some will ask you, what are you even doing here? That breaks the spirit. But when encouragements are given from time to time, not only when they are not only when maybe they want to get you to do something, but oh, you know what, you've done 5 good and 2 bad, but you know what, your 5 that you've done, recognize this. However, you can do better in this aspect. However, these are the lapses that we've noticed. You can do this and that to make yourself better. Leadership training like we are doing right now and all of that. It will help to foster much more, what I call it now, beautiful dynamics in play for the employees and the employer. Did I answer your question? Hello, Daniel. Did I answer your question? I don't know if Steve is with us. So I don't think Jamie is with us. So Ronnie, you can continue.
All right, thank you for that. All right, I can see number of people. Let me see whose answer up. Okay, Grace. Then after Grace, we have Ridwan Said.
Okay, so I just wanted to contribute towards the employer part. I think that most organizations, especially if the business is a one-man business, so I'm looking at it from another perspective here. So really, there's little to nothing you can tell somebody that owns his business. It's the way he wants to run it that he will run it. So if he doesn't believe in petting anybody in the back or appreciating little things so that person can put in more effort, there's really nothing you can do about that. So if it doesn't sit well with you, you can as well just leave the place and don't allow it to affect your mental health and go for bigger things. But in the other perspective where the employer is actually not that kind of person, and also make sure that the employee grows, and there are some organizations like that, they want, as the organization is growing, the employee too is growing. So I believe that the ideal things that employers are supposed to do in terms of, trying to, is it to talk or to give jobs to or tasks to employees to do. They need to come from the point of empathy, because apart from the fact that we are all working for somebody, we all have, every human being have one ego or the other in the body. So you cannot come and talk to me and then anyhow, and then I'll just look at it and I'll be happy about it. So I think employers need to, because I believe that before any employer became an employer, he or she was once an employee. So I think that they should step back and also look at how they affect, and rewarding is very important in every organization system. So when you see that a staff or an employee is doing well, there's always that need to reward that employee. It might not be in salary increment, it might be recognition. So you can try to give awards or try to, a little thank you from your boss self can make you say, okay, yes, you are doing something. So it helps encourage that employee, also foster like teamwork and all that. So I feel like when the employers try to, understand where we're coming from, maybe we will not be having some of the issues we have currently in our place of work. Thank you.
All right, thank you very much for that contribution, Grace. All right. Just in case any other person asks question, you can either type it in the comment box or raise your hand, because we would be wanting to round up in a few minutes. So Ridwan Said, please, you can go ahead.
Okay, yeah, thank you so much, Tolu Animi. I just want to speak to part of the question Jamil asked earlier, and specifically where he mentioned respect. And I believe respect is part of what should be the core value or culture of an organization, even in humanistic dealings. But what I just want to mention quickly has to do with the fact that if we mention respect in corporate organization is not until you had to use massa and all those our traditional or tribal way of managing respect. But however, in a corporate organization, the respect therein to me has to do with your disposition to the work. For example, if I'm the head of an organization of a department and normal, the hierarchy and other things need to be there. If you say you respect me, you respect my work, or you respect my level, your disposition to the work I ask you to do will determine the respect you have for me. Because for instance, I ask you to do something and get it done within the next few hours, and it's taking to days, weeks, and yet not delivered. That is not a sign of respect. And by extension too, what will dispose towards other people's time is also part of the respect. For instance, we are meant to converge 5 o'clock and other people are joining the same meeting by 5:30. It shows that that individual does not really give the respect to other people's time. But basically, that's what I just want to quickly chip in. Thank you.
All right, thank you for your contribution. Thank you for that. As much as there might always be disparity between what employees would want and what employers would want, it's always very important to have a synergy, right, between the two ends. Because for you to work in an organization, you'd have to buy into the vision that organization has, right? So it's very important that as much as we would want, everybody would want to progress in their careers, always look out for cultures that are in place in such organizations before you get into it. Because you might find out that an organization can have a toxic environment while some might be very good and progressive, right? So it's very important to make due research, right? And also on the part of the employers should always make sure that the health of, now when I say health, not necessarily that physical health, it covers mental health also, of the employees are also at least at the top of one of their concerns, because the employees are the ones making sure that the work is being carried out. So if you do not have competent employees or employees that are able to do what they're supposed to do, then the business will also suffer for it. So while it's important for the employers to make sure that the employees are well taken care of, the employees are also obligated to make sure that they do what they ought to when they ought to. Most of the time, we will see cases whereby an employer can start out as a very nice person, but due to experiences with different employees, maybe dragging their feet at work, not doing what they ought to when they ought to, costing the business money and all, the employer can decide to take drastic action and just change up different rules that they have in the organization, just because they are trying to just put more things in place, stricter regulations to make sure that what is being done is being done. So we also have the obligation as employees to do what we ought to when we ought to, so that there would be a peaceful relation between both the employers and the employees. So I would just like to go around every percent. Okay. All right. Paul, you have your hand up.
Yeah, thank you everyone who has contributed meaningfully. I believe we've had one or two things we can take back to reflect on. And I also think that all that we have discussed is an eye-opener, especially on the areas that relate to enhancing our effective skills in relation to what Dynamic presented, and our cognitive skills in respect of topics that have been discussed on accounting, on auditing and tax. We can't finish everything today. No time is even enough to cover all that you need to do, but you know better how each of these topic of discourse relates to you. You've been able to see areas where you need to make much more research on, study on, and enhance your practical skills, right? But to wrap this up, I want to give the opportunity to each of the speakers to have their closing remark. Is Enoch there? Let's start with Enoch. Enoch, are you there? Okay, while we are waiting for Enoch to come up, Adekemi, are you there?
Yes, I'm there.
Yeah, can you give your closing remark, please?
Okay. Thank you. Proper accounting for withholding tax transaction is essential for accurate financial reporting and tax compliance, whether be it a payer or the recipient. Understanding the relevant journals entries to these steps of this withholding tax will ensure that the taxes are deducted, remitted, and reported correctly. By adhering to these guidelines, so businesses can avoid the penalties and claim the tax credit notes effectively and maintain the smooth financial reporting process. Thank you, sir.
Thank you very much. I think everyone could get from there that the need for right presentation and documentation is very key. Thank you very much. Nimi, can we have your closing remark, please?
All right, sir. So I would say that as auditors, as much as we would want to, I'm not being paranoid or anything, as much as we want to trust that our client has done the right thing, we should always apply professional skepticism to our work and ensure that all proper checks and processes are being followed in all our engagements.
Yeah, auditors are always very skeptical, always looking for what may be wrong. So if you are working in an audit capacity, make this word your guideline, and I think with that you always dust everything that needs to be dusted. Thank you very much, Nimi. Is Enoch back?
Yes, I'm with you, sir.
All right. Can we have your closing remark, please?
All right, sir. So I want everyone to take this home, that whenever we are in transacting or going to a vendor account, we need to see those transactions that actually attract withholding tax and the applicable rates we need to use in deriving the withholding tax that will be payable. And also we need to understand the tax authority in which the tax will be remitted to, which I've said earlier. They won't go and pay the wrong amount to the wrong tax agents. And also, whenever we are going to the complete account, we also need to ask for some source document like the bank account, the management account, to confirm the transaction itself, so we can carry the due diligence on the transaction, so we can, if the company we want to remit to us actually have the tax and the team tax identification number. And also we need to also know if the company we are in question also is a small company, because we understand that small company they don't remit and they don't withholding tax. And what we mean by small company is any company that their turnover is below 25 million naira, or if the transaction carried out in a 12 calendar month is less than 2 million naira. Thank you.
Yeah, thank you very much for your contribution. But I want everyone to also think about this. We've talked about withholding tax before we get to the last speaker. Should government actually be collecting that withholding tax? Can't they just wait till when the tax is due for the right amount to be paid? Why do you have to pay this in advance? It's a food for thought that everyone has to consider, because in countries like the United Kingdom, there is no sort of tax like withholding tax. We need to think about it. Dynamic. Yeah, your closing remark, please.
All right. Thank you, sir. Thank you so much, sir. My closing remark would be employees should, cultivate this environment, an environment whereby trust is one of the main pillars of the organization, to help bolster transparency and fairness. And as much as we desire good leaders in our workspaces, let's be good employees ourselves. We should not wait to be spoon-fed. The word has gone past that. We are supposed to, everything's quick now. You never know how your right attitude to work or life might influence even your boss. Always spread love. That would be my closing remarks.
Yeah, thank you very much. Always spread love. I want to believe everyone has had a good time today. For those who have made contributions, we appreciate you. For those who are still feeling shy, we encourage you in our subsequent sessions to have one or two things to contribute or to ask. I wish you all the very best. Enjoy the rest of the night, and happy new month in advance. Good night, everyone.
Thank you very much.
Thank you, sir.
Good night, sir.
Good night.
Good night, sir. Good night, everyone.